Andrew Horowitz, thanks so much for coming back on Wall Street Unplugged. What's going on?
Hey, Frank, how you doing? It's summertime, and look at that. Look at what's with the hair.
I don't know. They cut a little short to have someone new. It's really short. I mean, I really don't care. Like, it always grows back, so I know people get upset. But
it's looking really short, like right? I'm gonna make a wild guess here for a second. It looks like you're either going to be entering a strongman competition or a bodybuilder competition. Just sort of getting that look.
No, I just been working out and trying to stick with it. But I mean, you know me when I was really, really fat back in the day. So
large.
I had to lose weight. We have hefty kids and everything. I think we were both there, right? We were both like heavier. You lost a lot of weight. You look great.
I was a good 30 pounds heavier than I am now. And then I was down. I'm also 30 pounds heavier than at my lightest. So kind of goes back and forth, but still keep it off a little bit. It's tough. It's tough. The older you get, Frank, you'll know the older you get, it's like, I didn't eat for 3 days. How come I gained a pound? I don't understand, It's crazy.
Yeah. I went to a barbecue and I'm eating like a burger, and then I had another one without the bread, then the fruit, and they got cupcakes out and everything. I'm like, man, it's hard. It's not easy. It's hard. And I'm miserable, man. I love eating. You love eating. Look at all the pictures you post all the time. Guys, you got to see, your posters on your Twitter feed and stuff like that. But the food that you cook and grilling, and it's just amazing, man. Really, seriously. I hate when you send me that stuff, to be honest with you. I kind of wish I was there.
It's tough. It's tough. I mean, listen, it's tough. There's barbecues, there's birthdays. It's not like, a kid's birthday is one thing. Like last night I went out to a birthday party. They went out to Capitol Grill we went out to, and there was just a table full of food. I'm like, I don't want any. I'll try it. Yeah. I'll take a little bit of that. And then they had at the Capitol Grill, they have this thing called the Generous Pour, which is like 7 different wines that they pour for you. And it's like, I don't want any of those. I'm like, okay, can I take a refill on that one and a refill on that one? I like the So as you get older, the birds just get a little bit more fattening, I think.
I hear you, man. So look, I love having you on, especially, right before earnings season. You're always giving out ideas and stuff, but usually we send notes to each other back and forth before the interview, or maybe, topics that we could touch on or whatever. And one of the things that you said was interesting, because I'm getting the same thing here. You have earnings coming out, you have stocks all-time highs, household wealth all-time highs, and you said something interesting where clients are worried, about a market crash. I'm hearing the same thing, and if it's even possible, because we have our government and the Fed, which is like the same thing now today, basically going to do everything in their power to avoid a recession, right? So how do you answer that? Do you say, well, for me, I'm always like, look, you got to be cautious, hedge a little bit of your portfolio, hedge. Hedging was the worst thing you could ever do, and in the past 7, 8, it keeps going higher and higher. But it seems like eventually it's got to stop, right?
So it's interesting because I kind of made this analogy because this week on the Disciplined Investor podcast, my podcast, and I talked about this idea of jumper cables because people are like, hey, you know what? What's going to derail the markets? I'm really worried that I have some cash. I don't want to put it in right now because the market's going to crash. I'm like, listen, let's slow down. Their biggest worry is what happens if the Fed starts to pull back. And I said, and their biggest worry also is if the Fed doesn't pull back. It's kind of like, okay, no matter what, they're worried, right? And I tried to make this discussion and this this viewpoint of, when a car battery dies, what do? Well, you call a buddy like, hey, you got jumper cables? Come on over, and you kind of hook it up. You let it charge for a minute, and you charge it up. Then you turn your car over. You take the cables off. You're ready to go. Then the internal components of the engine, the alternator and everything depending on what kind of car you have, if it's a non-electric car, will keep it going, right? And charge those batteries and get it going. Well, the same thing with the economy. Right now, we have the jumper cables very firmly engaged with regard to the Fed, to the economy, probably longer than they need to be. One day, they're going to pull those jumper cables off, and the economy theoretically should be running on its own through its own growth process, et cetera. Now, the problem is they're here for too long. We saw the inflation numbers come out today, a whopping 0.9% month over month, the largest since like 2008. We saw 5.4% year over year, which is substantially higher. It was 0.4% higher than the expectation. So what's really interesting about that is it didn't seem like a lot, but if we went 0.2 in the past, it would be a big deal. Markets aren't reacting because the Fed has had their hand on the pulse and probably bonds not moving up, which was very interesting. They did drop down significantly after the news, but right when the market opened, the bonds started dropping down, a lot of excess money going in there. Answering your question is this, is there going to be a crash? What can happen? The only thing that I'm looking at right now is the potential for the Fed, which they're not going to do, is to pull out premature, or not even prematurely. It's at a point where they go quickly. They're not doing it. The second thing is earnings. Expectations are really high. And I know you, Frank, you read FactSet's information, right? And you saw the numbers.
Great, guys. Guys, FactSet, just go to Google, FactSet earnings, PDF, and it's for free, and it's amazing. They give you like a nice 25, 30-page report of everything that's going on, yeah.
Right. Yep. Update all the time.
I mean, you're looking at
one
earnings.
Of the things that we... Yeah, one of the things that's it's interesting in this most recent earnings season, there's one thing that's different about this upcoming earnings season than has been pretty much in any earnings season going back years and years and years. There's a few times it's happened before, but basically there has been a view, and they wrote about this, and I'm going to I kind of made some notes here. I said, on average, the quarterly bottoms-up EPS estimates usually decrease during a quarter. During the past 5 years or 20 quarters, the bottoms-up EPS estimates before earnings season has recorded an average decline of 3.8% during the quarter, which means that analysts are starting to sandbag a little bit, pull back a little bit, waiting for companies. Companies then jump over the hurdle, they beat it, and it's great, right? That's what we see all the time. A penny here, a penny there. During the past 10 years or 40 quarters, the bottoms up has recorded an average decline of 4% during the quarter. And during the past 15 years or 60 quarters, the bottoms up EPS estimate has recorded an average decline of 5% during the quarter. What's different in this quarter? In this quarter, analysts increased their earnings estimates for companies. They increased it by 7.3%, only second to the time they did it before, which was when? The first quarter of this year, when they increased that by 6.5%. So what we're seeing right now is a very interesting situation. It's kind of like the economic surprise index. You've seen that, where analysts swing both ways and they're always on the wrong side of the pendulum. And what happens is they always have to, change and update. I am just concerned that we've gotten too far ahead with estimates and valuations temporarily, and especially as we're seeing it with the FactSet research information. Something to think about.
Now let's bring everyone in here. Yeah, let's bring everyone in here. So what Andrew's talking about is the institution. So most investors who don't cover it, like Andrew and myself, this is our job to cover this, is when you put on CNBC to see if your company beat earnings estimates, they're going to say they beat them or they missed estimates. That estimate is a consensus estimate of all the analysts, the institutional analysts, sell-side analysts that cover it, that provide estimates. So they come out with that median number, and then, if you beat it, you beat it. So it's whatever the analysts think. And usually the analysts, which you don't hear, right? You only hear about upgrades and downgrades in between the earnings reports, is they lower estimates a little bit. This way they come in, a lot of these companies beat even those lower estimates. And now you're seeing them raise estimates, which is interesting. It is a game. And it's important to understand, because a company could say, wow, we blew out the earnings by 40%. But you know what? Analysts may have lowered those earnings by 25% going into the quarter, right? So it's still the same number. I mean, but you just, the expectations were a lot lower, right? Because that's what you see. But, more to the point here is you're worried. What I want to see this earnings season is the guidance. I want to see how they feel providing guidance, because now you have the Tokyo thing with the Olympics. You have the international thing, right? Where it's a joke. I mean, there's 1,500 new cases in Tokyo. Just to put that in perspective, UK is opening up everywhere. There's 24,000 new cases, right, per day, and they're opening up everywhere. But Tokyo's like, we're not letting any spectators there because we believe there could possibly be an outbreak.
There's 43. There's 43 in Israel, and they're going to new quarantine procedures of anybody coming in, and soft lockdown procedures right now. So we're seeing that there is in look at Australia. They went to a straight up, full out 2-week or whatever it was lockdown. I think they had a massive surge of like 12 cases. And I understand that they don't want the local spread. They're really concerned. Listen. If we have to admit one thing, that if you are in a situation in your own personal household, let's just kind of put it in that block right there, right? That, there's everywhere outside, you're starting to see some stuff going on. You don't want it in your own. You shut the door, maybe it won't, spread or whatever. All I'm saying is that they're getting a little bit crazy with some of this. There's no question about that. And certain countries around the world are Israel's the interesting one because they have one of the highest vaccination rates, right? Question is it going to hurt the economy? I don't know.
Mm-hmm.
Yeah.
Well, that's
like
the thing.
92%.
You're looking at what is it? It's around 30-35%, I think, the profits come, from overseas. But this is kind of a surprise, right? Because we thought everyone was kind of opening up, and we didn't think it was going to take a setback internationally. We're fine. U.S. is opening up. It's different, but that's what you want to look at earnings season, because how do you forecast for that for those guys that? And I have to tell you, food companies, exporters, it's going to be hard to forecast. What about the autos? I mean, you think it's bad now? Wait to next 2 quarters. Holy cow! I mean, people don't understand how bad the auto industry is. There's 10% of cars on the lots right now. They can't get anything. Their plants are still idle. They said they were going to open them back up the last 2 months. They still haven't opened some of these up. You're going to see massive decline. So what companies have exposure to that, and what kind of guidance are they going to provide? I mean, there's a reason why you see Ford and GM talking about their EV portfolio, which isn't coming out for another 8 years, is because we really can't tell you anything about what's going on right now, because it's going to be pretty terrible production decline. So keep this in mind during earnings season as an investor. Companies usually, maybe not today where everything is bullish. Usually when companies don't provide guidance and they're supposed to, the stock gets hit. It means there's uncertainty, and the only way you don't provide guidance if you think it's going to go a lot lower. So I'm interested to see the guidance. These earnings are going to be fantastic. You're going to see blowout numbers, but going forward, I think, want to see the guidance. And do
you think, though, think they're going to see a return? Do you think we're going to see a return to, once again, getting guidance from companies? Because under the umbrella of, we're in a COVID environment, a lot of the companies said, you know what, we're not going to supply guidance anymore, right? And it was like, okay, all right, that's fine. Okay, no problem. And then they start hearing, well, you know what? Quarterly guidance and quarterly earnings, maybe it's not the best thing to do. We should be looking a lot longer term on the company, right? So investors look beyond. Look at the cruise lines, look at the airlines. Things weren't picking up. Things were still shut down. Things are pretty much still shut down for the cruise industry to a big degree. And meanwhile, the stocks made massive runs from their lows, right? Mm-hmm. So do you think they're going to actually come out with guidance? And is that going to be important let me just ask one other question and tag this with it. In an environment that information doesn't matter, it's all about just pouring money into a stock or into an index to move it higher.
You're right. I mean, it's about the liquidity coming into the market. I would say it's not a black and white issue. I think for airlines, it might be a little difficult because you thought international travel was opening up, and that's not. And that's a big part of their business. The Delta is the major airlines, United Airlines, UAL, and United. But for the cruises, again, those ran up. People don't realize this, but so you're looking at the airlines. The airlines ran up, right? So they were like trading all-time highs, great, before COVID, pre-COVID. They've come down, and then they've gone back up. They were still trading around 20% off their highs, and now they took another leg down. They never got back to the highs. Cruises, on the other hand, they were like their enterprise values were higher than when they had every ship in the water and full ships, and they barely have any in the water. So I'm like, man, those expectations are kind of high. But,
the debt load. The debt load is ridiculous. The amount of debt the airlines took in, and then to see that United is making an all-time the biggest purchase of planes, and it's like a year ago, you're wondering if these companies would still be in existence in like 3 months. And that's the thing that's so fascinating about the airlines and the cruise lines. Think about how lean they run and the cost factors associated that these companies, after like a couple of months of not doing, they were like shutting down. There was like no backup plan, right?
Yeah. I mean, that never happened in the history, right? Well, you could see they don't really forecast for a 20% decline. Maybe if they forecast for 20-15% decline, what's going to happen? No major company forecasts for a 90% plus decline where you turn it off. So, they did get some help from the government, which is fine. But now when you look at everything open up and the pricing power, everybody has money. They want to travel. They need to get out. I mean, this is a massive boom to these guys, right? So it's going to be interesting how they do report. But just for other companies itself, look, you shouldn't be impacted by COVID anymore. If you're a Eurospace company, there's no way you should not be able to forecast. Everything's open. I don't care if you're a restaurant. I don't care if you're bars. I don't care what you are. Everything is open now. And it's just a matter of opening. So now you're going to hear more about the labor shortages. McDonald's just came out and said we're paying employees and going to tuition and stuff like that and giving incentives. I mean, you've seen that across the board. That's going to be a big story. But, going forward, Andrew, which you mentioned earlier a little bit about the government, they're always the one thing that scares the hell out of me. And people aren't nervous because you've seen a 10-year come down, right? It is inflation. So we do have inflation everywhere, but the 10 years coming down. It's confusing people. The bond market's not showing you, so people aren't concerned. Inflation is the absolute worst thing because the only way to the Fed can't control that. The only way they can control it is they got to remove money out of the system. They got to almost force a recession. They got to raise interest rates. And that's an environment where if something, they could bail out and listen, they just spent $10.5 trillion to bail out the world. They'll do another 10, 20 trillion. It just comes out of thin air. Just turn the printing press on. This is something they can't control. So if you better hope it's transitory. I don't know if it's transitory. I hope for everyone out there it's transitory.
How could it be transitory? How could it be transitory if you're telling me that the cars are not going to be on the lots? It's simple that it's going to be transitory?
It's simple. Don't everyone that's raising prices for their business is suddenly going to lower prices. You didn't know that? I'm agreeing with you. I'm being sarcastic, but it's not. I mean, think about it. If you're busy, you're raising prices for food, for everything. You're not going to say, "Oh, okay, hey, we're doing better now. Let's lower prices." They still having labor shortages. They still open up at 80% capacity because they don't have enough people to work for them. So, yeah, I'm agreeing with you.
I mean, listen, once you use whatever phrase you want, once you let the genie out of the bottle, once the toothpaste is out of the tube, it's hard to get it back. But the truth is that, you know what? We're seeing this across the board in so many different things. It's not only this is where the farce of all this comes in. It's not only about prices going up due to demand, right? There's some supply issues out there. You know, I am a boater, as you know, trying to get new engines. It's impossible. Put an order in April, can't even get a response as to what's going on. Meanwhile, I sell my engines, one day they're gone. Now, fortunately, I'm not an idiot. I didn't take my engines off before I got my new engines, right? So we put that in the contract, you know, between myself and the buyer. And actually, I told him, you know what? I don't know when my engines are coming in. I have no idea. I heard it's going to be maybe a year till I can get engines. So the problem you're having is that with chips and cars and resins and all sorts of other products, hinges, issues with stainless steel. And it's a combination of the restart is also a problem that was predicated on the just-in-time manufacturing process that is not good in a shutdown startup economy. It's fine if things are rolling along just fine, but you can't do that without any inventory backlog. And I don't understand if you have the supply chain issues that are going to go on for some time, on top of the fact of all this free money, on top of the fact of what we're seeing in food prices, et cetera, how this is going to be a transitory inflation discussion, unless they say 1 year from now, look, we're still not rising as much as we were, right? That doesn't mean prices are lower. That just means that we're not seeing the consistency of massive price increases. So we stay at 5.5%, which is much higher. Attention Fed, 5.5% is much higher than your 2% average. And you get to that point, and even if it's at 4% for a while, it seems to me that companies are going to have problems because margins are going to be squeezed. Don't you agree with that, right? And then they're going to have to either pass it on, which is going to cause problems for the consumers. You know, it's just something that, and then the Fed, what they're doing is they're buying $120 billion of bonds. Who knows if when these inflation numbers come out, they don't go to the market and start buying all sorts of treasuries to kind of make it look like nobody's concerned. You know what I mean? I mean, this game is ridiculous.
No, I know what you mean. I definitely know what you mean. And it is crazy too, because you talk about margins, and I will tell you that, you know, for the margins, I think this is Credit Suisse that came out with this, but it was, I'm trying to find the exact number here this way, because I wrote about it. But so companies already posted Q2 numbers, very, very few, very small sample size right now. Everybody's reporting in a couple of weeks. Right. They have an average revenue beat of 4.5%, right? Again, small sample size. But historically, a 1% revenue beat is accompanied by a 4% rise in margins. So it's going to be interesting to see how that's why forecasting is going to be tough. Because if you're growing sales and you're beating sales, you almost have to forecast that margins are going to be better. But are they going to come down? Right. And that's when you see if they think margins are going to come down, why they're going to come down. Is it pricing? Is it whatever? But there's a lot of stuff going on under the hood. And I mean, this earnings season, it's going to be I say this a lot, stock pickers market, where I feel like even the last 10 years, just do a dart and you know, you make money. But there's a lot of stocks getting nailed right now. You're not hearing about big tech. You talk about growth catching up to value too. You know, value.
Wow, wow, what a move! I was just
reopen trade, right? Was big. Yeah, right.
Now we're back on the panty trade.
Yeah.
You got the pandemic trade is happening again. You got the big tech concentrated in $8 trillion worth of net capitalization. You had Apple and Amazon hitting all-time highs, and Google and Microsoft, just those 4 companies. This is after you get an inflation read that's really hot and an instant move of the bond yields higher. Then the markets open, and all of a sudden it all turns around, and you get the NASDAQ outperforming, which is totally insane, by the way, except for one thing. Except if that's actually not what's going on. What's going on is not anything to deal with that, but it's more of a safety trade into bonds, right? And a safety trade into large cap tech, which is cash heavy, good balance sheets, buybacks are going on, easy borrowing and all that, and consistency, cash cows. That is what really, in my opinion, as we see a narrowing of the breadth in the markets, is something to watch. It's something that we saw in the latter part of, let's call it 2019, 2018 to a point also, and then during the pandemic as well, because we're seeing that reversal of the big trade of, infrastructure. But Frank, did they pass that infrastructure deal yet?
Not yet, but I think when they do, I think it's like 7% is going to infrastructure. So I don't know if it's a big deal or not. But it's so. You know what I find funny? Is that both sides campaigned for the longest time on $1 trillion infrastructure package. So they both
shovel ready.
But we haven't gotten anything out there because, again, they hate each other that much. They can't agree to whatever. It's frustrating.
They're buffoons. They're buffoons. Yeah, they're buffoons. All they're doing is talking about what can get them elected. Let's be honest about that, right? The thing is that they talk about this. I don't understand why the first part of this bill hasn't been passed if it was like a layup, except for the fact that we have earmarks, we have sausage stuffing, we have, a whole bunch of pork going into this right now. And I think there's a lot of problems with that. And I think there's some concern about how much is too much. How much of a good thing is too much. You want to do a little research?
You want to do a little research out there? So you look, everybody crazy with the Miami, right? Miami building close to the units for me in Florida. I'm in North, but you're in Fort Lauderdale. But still, that Miami collapse, that's a 1980 building. Guys, go and read the bridge and dam reports that have come out from engineers saying how important that there's a dire need to upgrade this stuff. Our water pipelines, everything. The infrastructure is extremely, extremely, extremely old. We need this. You have to come out with something. You're going to see more of this stuff happening. It's not going to be nice. You're going to see a dam crack. A lot of this, they're coming out saying with the engineers, we need this, just like they did with the Miami building. Not, God forbid if that happens again. It's just, you got to get that infrastructure updated. A lot of these buildings are old, a lot of dams, bridges. Come on, guys. I mean, this is, this is about people, it's about lives. But anyway, I don't want to get too crazy.
Around the whole country. But around the whole country.
Absolutely. Yeah. So let's get to the fun part of this, which I know you love and I know everybody loves, right? Is your ideas. And you've been amazing when it comes to stock picks on this podcast, which we technically do Dollar Stock Club. You like a couple of picks. We'll get to one, which is pretty crazy. I think I like it, actually. It's just crazy when people are going to hear it. But let's go with some of your picks that you like right now, because there are a lot of interesting things on this list.
So, I mean, there's there's a lot of interesting ideas, some outside the range ones. One of the things that I'm looking at right now in a time when it's like, hey, things are going well because of this, or maybe this company's doing well because of that, is the idea of, hey, if something goes right, if we use the theme of if just one thing goes right for this company, there could be a great opportunity. A company called Workhorse, old SPAC. Basically, they make EV, we'll call them cargo vans to a degree, right? They're in that genre of all these other companies that are making some kind of EV for commercial usage in their particular instance. One of the big things that happened and why the company rose up for a while was that they were supposedly in the running for a post office deal, right? And what they were in the running for was to get postal trucks. And then we saw there was a big deal, a couple of, I think, $1 billion worth of deal that went to Oshkosh. Now, what was interesting about that deal was there was a lot of talk about EV. The whole federal government's going EV by whatever year it was. But yet a lot of the trucks that Oshkosh were building were either hybrid or some other form of fuel, maybe natural gas or something. Still maybe cleaner running than combustion engines with gasoline or diesel. But all of a sudden it was like, hey, what happened to Workhorse? And if you look at that chart, once that happened, Workhorse went like straight down. And now there's some lawsuits. Yeah, see that little, right there. Yeah, right. Mm-hmm. Boop. That's Oshkosh.
Crash.
Okay.
It's like a typical SPAC, right?
Yeah.
They go up, and then the insiders are out, and then boom, goodbye. I love it.
But that was the news specifically on Oshkosh got the deal. Now what's happening is there's a renegotiation. Now you may say, well, the government never changed their mind. Well, I don't know about that. Look what just happened with the Pentagon deal that they gave to Microsoft. Now that deal was shut down, $10 billion contract. And you see that Amazon making all-time highs all of a sudden again as the potential for a shared contract. I would venture to say if one thing goes right with Workhorse, that the potential is for an opportunity. It's very aggressive. It's not for everybody's portfolio. It may never happen. But I'm just saying the opportunity. And you can see that when there was some discussion about this, the stock starts percolating up. So kind of an interesting situation there. I think there's 40% upside on that pretty quickly if we do see that even part of the contract goes there in their way. So that's one. The other one is DD, brand new. DD's interesting. It's you like this? You hate this?
Yeah, I'm gonna punch it up. You're crazy. I love it. I love the idea. I really do. So I mean, we everyone knows the story. It's been going crazy. Just IPO'd, right? Let's bring this up.
All right.
I'm using CNBC. Sites that people can follow along. So yeah, go ahead.
Yep. So the thing is that, do I love DD? It's fine. It's an Uber. Do I love Uber? Don't really like Uber. Lyft, and I'm going to lose money for a long time. Still, people like it. Investors like it. You know, DD does a lot more than that. They do deliveries and shopping services and car services. Well, you know what? The problem is that there's a lot of money being made in China right now, and a lot of the government agencies are like, you know what? You know, there's a kind of a toll road here. You need to pay us. And they came out IPO'd, probably found something to do with the problem with how they held the data for the clientele. China shut down and took away a bunch of apps in the App Store. I am certain probably this is going to blow over. Pretty certain this is going to blow over time. Anything can happen. But just like what we saw with Ant Financial when Jack Ma got the hand slap and Baba and a few others came down and Tencent came down, I think that DD long term will probably just say, hey, we fixed the data breach, the data problem that you say we have. And by the way, here's a couple of $1 billion. Fine. Okay, thank you. They pay the toll. They're done. Stock goes right back up to where it was pre-news.
You know what I love about this pick, Andrew, is because when you're looking from an investor point of view, it's very hard to buy a stock like DD because you look at it because all the news out has been so negative, right? So people look at this thing and they say, okay, look where it was. It went up to 18. It's 11. And, you know, most people want to buy it at 18. You're programmed to buy it when the most excitement's there and you don't want to touch it here. And it's up like 5%, you know, take off its lows.
Right.
But what I love about this is what you have to ask yourself is what other negative news could come out on this, and there could be some. There could be like a whole scheme where they, but I mean, they took their app off. China's coming after them. It's infecting the whole industry. Everyone's pulling it. I mean, what else could go wrong to this thing? Where, like you said, with the last stock, right? If everything goes, it's just one thing. You need one thing to go right, and this thing's going to go $13, $14 base out there. And if it goes right, you're looking at this thing really taking off. But again, it's Uber. Think about Uber here. Okay, Uber's great and they're international and stuff, but you know, our population is a lot smaller than China. In other areas that you know, so it's I kind of like this pick because it's against the grain and some people look at it. That's why I was laughing because no one's out there. No one goes on TV. So I'm gonna, DD might be a good play here, but as a speculative play, this actually makes a little sense. So I hear you on it.
The other one is, I'll just give you one more, is the view that if in fact we are in a pandemic trade again, what isn't in the pandemic trade, right? You know, so we see Walt Disney. Walt Disney has been a really great PR machine lately, better than anything else, in my opinion. You know, they're putting up this stuff, and it's, you know, I've never seen so much news between Boeing and Disney. It's like they share the same PR agency, I think, that's just constantly pushing out information, all the specs on the Black Widow and the stuff on Disney Plus and how great it was and how it wasn't. Well, you got that, you got Yum Brands, you got Viacom. We'll see what happens there. Starbucks, Everett Holt, AMC Network, Cisco. Hey, one of the ETFs out there is called the Travel and Leisure ETF. It has more leisure at the top holdings, but there's some travel below it. Thinking about shorting that. You know, looking at that as if, in fact, the pandemic is, whether we want to agree with it or not, Frank, is a different discussion, okay, of what's happening, where it's happening. If it does happen, if there are further, let's say, not even shutdowns, but quarantines or slowing of international travel, slowing of domestic travel, no more stimulus, but yet people can't get back to work and maybe some jobs being lost. You know, I'm saying kind of if there is another wave, whether it's Delta plus, there's a new Lambda variant coming out or whatever it is. And there was some weird story about somebody that had 2 different variants that got it. And now there's a whole discussion about breakthrough.
They're all covered by the virus.
I can't keep track of it.
Explain that. Yeah.
Right. Exactly. So I'm thinking about, let's take a quick short of PEJ is the symbol. Now, as a full disclosure, clients of Horowitz Company, myself, may own or short any of these. So I'm just making sure that's very clear when we talk about these.
Okay. I'm bringing this up now for you. So, yeah, PEJ, right?
Yep, PEJ.
Entertainment ETF. Wow. So
See,
shorting this?
Is there a holdings page there? Yeah, shorting is kind of topped out, triple top on the top there.
Is there holdings? I mean, CNBC is really bad. The reason why I use it is because I like
look at the profile. Go down the profile. There's the investment objective to the right. Fund 6 investment
summary profile. Yeah, too fast. Here you go. Summary news profile.
Go to the profile to the right. There you go. Fund details.
Objective.
Top 10 holdings. There you go.
Bookings.
That's
right here.
This has been moving around a little bit because I got a couple of different holdings, but yeah, AMC's in there as well. So travel and leisure, just a thought. Consumer discretionary, consumer services, 94% of the overall fund it's showing right there. So something to think about.
Yeah.
If in fact this pandemic trade is happening and you look at the reverse and inverse of that, could be an opportunity to hedge out. The problem with hedging right now, you talked about this earlier, Frank, is what do you hedge, right? If everything's going up, if we're seeing a terrible situation going on in the gyms around the country, and meanwhile Planet Fitness keeps on going up no matter what, what do you hedge out? So instead of, and if indices are going up, but like today was a 2-to-1 earlier today, 2-to-1 winners to decliners to advancers. That was earlier today. But meanwhile, markets were kind of like in the nowhere zone, right? And the NASDAQ was going up. Which index do you short? Better picking something a little bit more constrained, a little bit more directed, focused.
Yeah. I mean, with the Disney pick, I got to tell you, when it comes to Disney, Andrew, whatever I do the opposite and you'll make money on it. Because like you said, it's like when you Planet Fitness is like, doesn't make sense. When I look at Disney, I bring this up. This is the only thing that makes me know, because everyone's going back to like their pre-earnings, like pre-COVID earnings. Everyone's doing great. And a lot of companies doing great. What I see right here, look at this line with Disney really quick. And I see, look, this is 2018, 2019. Look, 12, this is their net income. You can go to earnings, $8.
What line is that?
$6,
net income? Okay. Yep.
So look, even diluted earnings. So you got $8 and $6. Earnings came down a little bit, but then you got the pandemic. Okay. Into 21 pandemic. If you look all the way out here, so here's pre-pandemic, 2019, $6.26. They're not going to get back to this level until 2023, which is insane to me because people are paying
where's the last, 30 times. Where's the last one?
This one right here, if you could see this, 647, that number.
Oh yeah, I got it. Yep.
Everything's hiding. So that's 647, and that's 2023 numbers. And guys, I have a YouTube research page. I'm showing that. Anyway, they're not going to get back to those earnings for a couple more years yet. So earnings are really crappy, but you're looking at a company that's trading at 30 times forward earnings, commanding a massive premium. Again, whatever I say about Disney, do the opposite, you'll make money, because I lost money. I thought this thing was going to crash a lot more. But it will be interesting to see with everything opening up. Now they have all these users. A lot of them have come on for free. They're trying to raise prices for ESPN Plus, and let's see if they can raise prices. I think it's going to be very difficult.
That was another thing they raised. Again,
so we'll see.
But Frank, some of these companies have a lot of change they can pull, right? They can, or what's the word I'm looking for? They can pull a lot of, they have a lot of things they can do. For example, that too. They could do a $1 increase on ESPN, right? Maybe they could do a $1 increase or 50 cents or whatever it is on Disney Plus. Possibly they'll do a quick up. Listen, the only thing they can't do, which would piss me off, is putting a higher price on those turkey legs that you get at Disney. Other than that, those smoked turkey legs, you've had those, Frank? They're
good. Yeah, they're really good. Yep. At Disney. Disney, yeah. And they're raising prices there too.
Levers they can pull. But a lot of the companies have this opportunity to do so. And just that incremental change of $1 or $5 on the park pass, getting rid of a discount for Florida residents or whatever it may be, is really very beneficial to them to the bottom line. So they did spread out. They've cleaned up their act a little bit. The problem is, are they going back and what are people willing to pay? Because it's not so much right now that things are just great, as you just pointed out. You showed it right on the screen. The thing that is now is that people are willing to overlook and willing to pay up in advance of them getting there. That's why the market is at an all-time high.
Yeah, no, definitely makes sense. So, and Andrew, I guess we'll leave it there. I mean, I love when you share ideas. You always share really great ideas, and I really like the ideas this week, though. They're pretty cool. Some good ones. DD and workhorse and stuff. But listen, we have to get together soon. I say this a lot. I love to go on your boat, hang out, see family again. But listen, keep doing what you're doing.
Come on down. It's dolphin season. Mahi-mahi. Hey, go over to The Disciplined Investor. Yep, go to thedisciplinedinvestor.com. Listen to the Disciplined Investor podcast each and every week. DH Unplugged each and every week as well. Just look up Andrew Horowitz on your googly thing, and you'll find out where you can get more information. Great discussion this week on the Disciplined Investor podcast. We talked about, again, jumper cables. Trying to make it, Frank, what we're trying to do on that show is to make it really user-friendly. Understand very basic things. One of the things that we did over the last number of months is all about, hey, if you're scared to get in the market, that doesn't necessarily mean you should be in all the way or out all the way, right? There's some ways in which to get involved in investing for your future that you don't have to panic at any level, where you can have, as I call it, 1 foot in, 1 foot out through a process of dollar cost averaging. We have this really interesting strategy that we built in order to do that for people. So it's really been a great help to them over the last year and a change, especially when people were totally freaking out and pulling out of the market, then had no idea how to get back in. Then it was too late. Then it was too high. Then it's going to crash. I don't want to get back in. No. That's not how it works. We got a plan. We got a way to do this for you. So check it out over on the disciplinedinvestor.com.
Awesome. So listen, Ian, thanks so much for coming on. And as always, I'll talk to you soon, buddy. Thanks, man.
Thanks, Frank. See ya.